All right, good morning and good afternoon. My name is Margaret Myers with Bridge Financial Technology. We are excited to be joined by RIA compliance consultants for our webinar today to focus on reporting compliance and best practices. Looks like we have quite a few people on, so we are going to go ahead and get started promptly since it is 1 p.m. Eastern. So thanks so much to everyone for joining today. Before we get into the presentation, just wanted to introduce the panelists who are joining me today. I am joined by our CEO and co-founder of Bridge Financial Technology, Rashid Hamouda, and we are also joined by Jared James, Senior Vice President at RIA Compliance Consultants. A quick run through of the agenda for today. We'll start by giving just a quick overview of the objectives for today's webinar, of course, and then introductions to each of our teams. Jared and Rashid are going to discuss then some frequently asked questions that we get from our clients around reporting compliance. And then we'll touch on some considerations for reporting specifically as it relates to some of the performance reporting that our clients are doing and that we are talking with advisors about. Just some important considerations there, followed by reporting retention and disclosure requirements. And then I am going to wrap up with a live demo of our reporting environment just to show how we can put some of these reporting compliance best practices into action. And then we will end with a Q&A session. So we'll be taking questions at the end. You'll notice at the bottom of the Zoom screen a Q&A button. So feel free to submit any questions throughout, and then we will get to those at the end. The objectives for today's webinar, we want to address a lot of the common questions that we hear in the market and from our current clients around reporting and reporting compliance. So we're really excited to be joined by RIA compliance consultants today so that they can provide their guidance and expertise in these areas. Rashid will also be helping us clarify some often confused reporting buzzwords, again, specifically as it relates to some of the types of performance reporting. And then we will be providing you all with actionable steps on implementing these reporting best practices at your firms. So with that, I will go ahead and turn it over to Rashid and Jared.
Thanks, Margaret, and thanks for everyone for attending today. I'm looking forward to going over some interesting and important topics. A bit about Bridge. For those of you who are learning about us for the first time, our vision is to build a better advisor through transforming financial data into actionable insights and information. We do that through software and data infrastructure that we provide to advisors in the market. We partner with a lot of RIAs and are always looking for other RIAs who are focused in efforts to do the same. We've been in business in this form for about 5 years, and we have an operating history of another 15 years prior to that as a services company before transforming ourselves into a technology company. A bit about our software then itself, Atlas. This is the technology that Margaret will be showing us our reporting environment for later in the call today. At its simplest, our software is a practice management platform for advisors to accomplish more in less time. So it's built on an automated data management and reconciliation engine that processes financial accounts into portfolio accounting. And then that serves as a platform for calculating fees, invoicing, doing client reporting, including performance, which we'll talk about today. We work with over 200 advisory firms today and growing. And again, emphasizing some of those key reasons that advisors tend to work with Bridge and our software is automated data management and reconciliation, flexible client billing options with automatically generated uploads and compliant invoices, and of course, reporting on a very high standard, which we will talk about the reporting methodology that we do and performance methodology in particular.
And I'm Jared James here, Rashid. Appreciate you having me on the call. And just want to thank Bridge and Margaret and everybody for hosting this and putting this together. I'm a senior compliance consultant, also vice president with RIA Compliance Consultants, and we're, just like it sounds, a compliance consulting shop that specializes and works with investment advisor firms. So we're headquartered in Omaha, but we have clients really all over the country and actually outside the country as well. Our focus is not just SEC compliance. We work with a lot of state firms, and that's probably one thing to think about today in our discussion. Talking about compliance stuff, I'll be talking a lot about kind of the SEC expectations, SEC compliance issues. For the most part, I think when it comes to reporting, there's some variances maybe with billing, but with reporting, SEC and state stuff is going to be similar. But if you are with a state registered firm, we always suggest, check with your state rules for those specifics and not just go just off the SEC. You want to make sure you're in compliance with the state stuff. But as far as our firm, we do a whole suite of investment advisor services, all kinds of stuff, registrations, mock reviews, ADV, drafting, compliance policies and procedures. Me personally, I've been working with RIA Compliance Consultants for 15 years. I've been doing investment advisor compliance stuff for 20 years. So we've got a well-rounded group at our firm, and just looking forward to having our discussion here today. And again, just thank the folks at Bridge for putting this on and doing this with us.
Thanks, Jared, and I'm really excited to cover some of those materials today. This is my first webinar, and I think yours as well, if I recall, but I believe this is the second one that RIA Compliance Consultants and Bridge has done together, and really great opportunity to leverage your expertise and your team's expertise on these compliance questions that we get asked so frequently, as Margaret mentioned, both by our existing clients and also just in the market. And we always recommend working with a great compliance partner like RIA Compliance Consultants to address some of these. So I'm excited to be able to cover some of these topics today. So in terms of at a high level, the questions that we get most frequently, and Jared, I know we talked about this before as we were prepping for this, right? Sometimes it's very simple, high level questions like, what do I need to show my clients? What am I allowed to show my clients? What am I not allowed? Where's the obligation? If I'm not obligated, does it mean I should do it? So a lot of the questions just come around at a high level, just sort of out of the gate, concern around making sure I know what I'm supposed to show my clients and the way I'm supposed to show it.
Yeah, exactly. I mean, I get this question frequently, right? Just simply, do I have to give them, the clients a report, whether it's performance report, position report, anything like that? I think a lot of investment advisors kind of depends on kind of where they grew up and, what firm they came with. There's some firms out there where, reports are a big part of that firm's practice. They talk about it all the time. And so kind of the thought is maybe that was a requirement. Well, quite frankly, it is not a requirement. There's no such requirement or obligation for an investment advisor to provide an account statement or account report. Again, whatever term you might use, there's no requirement to do that. The requirement, though, is that the custodian of the client's account, right? The custodian could be bank, most likely broker dealer, but the broker dealer of that account does need to deliver an account statement, and that has to be prepared by the custodian, delivered directly to the client, right? So an investment advisor needs to make sure that's happening. But I get a lot of feedback that sometimes those account statements aren't that great. They're pretty straightforward, depending on the custodian. There might not be a lot of bells and whistles to it, and it doesn't maybe tell the whole story. So then that's where an investment advisor will come in and say, well, we'd like to provide something above and beyond what the custodian sends out. And that's where, a tool like what Bridge has comes into play. It can be I look at it as a real service add, but that's really what it is. It's an extra service. It's an extra tool that you can give your clients. Now, once you decide to go that route and provide reports to clients, you better expect, right, the regulators are going to look at those and definitely, they become part of your books and records, and they're going to review those during an exam, make sure they're accurate, all that kind of stuff. I certainly have numerous clients that have chosen they just don't give out reports to clients, but they might still have a portfolio management system where they can develop reports for internal use. And so if you're doing something like that, it can still help your firm out, but more for research and analysis kind of behind the scenes. I put a bullet here as far as, ADV part 2. These are kind of the simple instructions, but there are some instructions, right? And it does say, in the ADV part 2A, that if you provide reports, describe the content, include the frequency of those reports you provide, and state whether those reports are written. So that's where in the ADV part 2, and Rashid, if you want to flip over to or I think it's Margaret, flip over that next slide. That's where this next bullet becomes really important, in that if you say to clients that you are going to provide a report, right? If you tell them you're going to do it, and if you put it in your Form ADV disclosures, or maybe there's a statement in your client agreement where you're saying you're doing it. At that point, it doesn't matter whether it's a requirement or not a requirement from the SEC level. You've said you're going to do it, so you got to deliver.
Right.
And so you want to make sure that any sort of reports are always consistent, not just with not just with the representation of delivering reports, but also consistent with what your ADV and client agreement says in terms of other things, maybe billing, how you're, the investment strategies. So it becomes an overall kind of compliance issue where you're looking to make sure your reports are consistent with ADV disclosures, and knowing that regulators are going to come in and compare any sort of report, any sort of document you put in writing, anything you give to clients, right? They're going to compare that against the disclosures you've made to clients, whether it's out on your website, in your ADV documents, in your client agreement, and know that they're going to review this stuff. I always like to use the word 20/20 hindsight, right after the fact, if that makes sense. I also like, again, from a compliance point of view, I like setting out those reports because that's a way to keep this information fresh in the client's kind of mind every quarter, every month, however frequent. But you can also use those. I put this last bullet here as a way to remind clients to contact you if there's been changes in their financial situation. So there's some tools there from a compliance perspective that you can use these reports above and beyond just simply informing them of the just sheer performance, but use it as a way to communicate to clients, remind them to contact you, that type of thing. So again, kind of a high level, those are kind of the big kind of FAQs, I guess I get. Just simply, can we do it? Certainly. Do we have to? No, you're not required. Well, if we do it, well, now you got to kind of go all in, make sure you have a good compliance program around it, make sure it's nice and tight, and don't take it lightly. Does that kind of make sense, Rashid, or?
Yeah, and I was wondering if you could maybe also speak to one of the points that we've discussed in our prep, where a distinction between reporting to and advertisement, and what we're sort of not talking about is advertising performance, and how just at a high level, a reporting compliance consideration, what we're looking at today, that's different than going out and telling a potential client, hey, I have, 20% average rate of return in a particular strategy. That's a distinct thing from my understanding. Is that correct?
That's exactly right. I mean, and that's a really important thing to make sure when you're talking to a consultant, right? Talking to a client, talking to whoever, that there's a big difference between giving a client information about the performance and how well their accounts have been doing, right? That's just information. That's kind of like having the one-on-one conversation with the client about their accounts. If you want to kind of aggregate the performance of your client accounts and put it into, or heck, not even aggregate. You could take a performance report of an actual client and give it to somebody else. That's what Rashid's talking about. That now becomes an advertisement. And then that's where, for our listeners that have heard about the Clover Capital no action letter, there's several other no action letters. So if you're going to kind of aggregate performance or and use it in a way to try to communicate how well your firm has done from a client prospect perspective, putting out some performance advertising, performance marketing materials, it's really a whole nother webinar discussion, because we could go on and talk about that for a long time. But today, we're really focused here on the performance reporting. And so the assumption here is you're providing a report to the account owner, focusing on the performance of the account owner's investments, strategies, portfolios. Now, with that said, when we get in here a little bit later, there's some good stuff we can pick up on performance advertising that we can maybe use in disclosures and other types of stuff when we're doing reporting. But the performance advertising is just a higher risk, higher red flag type area that the SEC will definitely look at really, really close. And again, look at it differently from the performance reporting that you're giving the clients.
Got it. That's a very helpful distinction. Then to dive in on helping folks understand when you are then choosing to deliver these performance reports. First of all, at a high level, one of the most common questions that we have when people are in the system or people are looking at systems is confusion around unrealized gain losses and performance return. One of the things, Jared, that you were talking about is the statements coming from the custodian, either that bank or that broker dealer. This is where clients will often see the unrealized gain losses, which the portfolio management solution may also be tracking. But simply put, those unrealized gain losses is not a measure of performance because it may not reflect changes that have happened previously in the account. It certainly won't affect flows into the accounts. So it's an important distinction, I think, to educate clients on too. And in particular, most clients are acclimated to seeing an unrealized gain loss. And because if that unrealized gain loss becomes a realized gain or loss, that's going to affect their pocketbook in terms of taxes. So I think it's an important thing to call out early on in your client reviews to make sure that your clients are educated that the difference between a performance measure and an unrealized gain loss is an important one to make. So an example of how this plays out, again, just at a high level here, you're looking at an account that owns 100 shares of a particular security, right? You can see the cost basis in this, if you look at it, is wildly different than the actual performance return for that account in that period. And the reason for that is, the cost basis, again, is a reflection of the initial purchase price, but it may not be a reflection of buy, sell over time. And then, of course, once you liquidate that, there's no cost basis anymore because you don't have that security anymore, which means then that the client is unable to see what an unrealized gain loss would be. So another important thing to call out there, right? Time-weighted returns and performance measures, they're going to be able to track this over time. And even if a security is no longer in the portfolio, they're going to be able to continue to see the cumulative effect of those investment management decisions that your firm may be making. In terms of the methodology, this is one of the most common areas of confusion. Again, once folks have made that decision, there's a lot of different options, right? There's dollar weighted, there's money weighted, IRR, TWRs. And Jared, I just want to confirm too, for everyone on the webinar, there's no compliance requirement around what methodology you use, correct?
That's correct. Yeah, exactly.
Got it. So in light of that, the decisions that Bridge has made in terms of the way that we calculate performance is really centered around time-weighted returns. That's a methodology that's been put forth by the Global Investment Performance Standards, which is part of the CFA Institute. And we use that because it gives advisors the most apples to apples, transparent and consistent way to measure returns over time, that focuses on the investment decisions and the management decisions that the advisor may be taking, right? So if your client is pulling cash in and out of accounts because they're either in a savings period of their life or they're in a distributions period of their life, well, those cash flows are adjusted inside the time-weighted return methodology, such that those effects are not going to skew wildly in terms of how it affects the return. So, again, at a high level, just important to call out the methodology and the motivation there. Other considerations. Jared, you spoke a little bit about this. Maybe if you could speak about why this is important to show and look at net of fees versus gross of fees.
Sure, and I know kind of one of those FAQs, specific FAQ, was kind of what am I prohibited from showing to my clients? Mm-hmm. And again, to go back to what Rashid was saying and what I said earlier is, there's not a specific rule that allows or disallows performance reports. So when people call me and say, what can I do? I always like to start with, what does the SEC require? What's the rule? And, there's not a rule I can just send you because they don't have one. It's not like the custody rule or the solicitor rule where there's some real kind of black and white type details there. But if you're thinking about what a performance report's supposed to be, it's supposed to show the client what actually happened. So if you look at it from that perspective, really, and then also look at this is where we could pull and look at performance advertising. The regulators really want net of fee. They think it's misleading. It's just not accurate to show really any sort of performance gross of fee. And that's true in a performance marketing piece, performance advertising piece. And in my opinion, that's really doubly true when it comes to performance reporting. So if someone were to say, what can I just not do? I would say I would never show performance on a gross of fee basis. Always show the deduction of your fees, maybe other expenses, because that's what you're showing is the actual performance of the client's accounts that are being managed by your firm. Does that help, Rashid, on that one?
Yeah, I think that's a great clarification and ties in really well with why we've made that decision as well, to have a default on a net of fee basis, and certainly in terms of I like the phrase there where we want to represent as close to what actually happened in all cases, right? And ideally, just for representing exactly what happened in a client account from a performance standpoint.
Exactly. And, one thing I was kind of thinking about when to bring this up, but, this is the right time. But, sometimes when you're dealing with reports, I do know that advisors will report on accounts that they're not actually managing. And that's another compliance consideration to make. So there might be some accounts that you're just as a courtesy including in the reports. And when I say I don't know what's the right time to bring that up, because I would definitely be covering that in the disclosures. Right. Sometimes we hear about under the line or whatever, but this is one of those areas like maybe there are some accounts that you're reporting on that are going to be gross of fee because you're not actually managing it, and so there's no net of fee. I would be also using these reports as a way to really distinguish that out, because even if you're not managing or trading an account, if you're reporting on it, you're bringing some extra liability and risk into your firm if you're not being kind of specific and detailed about the fact that you're not managing necessarily every account being managed. So anyway, I bring that up just because there could be a situation where you got some accounts that's gross to fee just because you're not charging a fee out of it, right? Or they're excluded from your management fee and you're just reporting on it as a courtesy.
Yeah, that it's a great thing to call out, and certainly something we get asked as well. And we should touch on it again probably when we get, I think, down to the disclosures again, because it sounds like if you are doing it, the short answer is you got to really disclose the heck out of it.
Yeah, and we'll talk about that down because I know we have some sample disclosures, and I can talk about it there as well.
Perfect. So then other common questions that we see on benchmarks, Jared, and this is another place, right, where what are the compliance requirements? How it's similar things. Do I have to use benchmarks? If I don't have to, what can I do? What's recommended? Another host of common questions we get. Would love to have you speak to the recommendations there.
Yeah, for sure. And in fact, I had a question like this just yesterday from a client about the benchmark they use and wanting to actually take a fee, try to show how the benchmark is net of fee to make it kind of more apples to apples. So anyway, we get this question. In my mind, I'm again, from a compliance perspective, I think if you're going to report on stuff, using a benchmark is a good idea. Really, it's inherent in the name. It gives the client something to compare the performance of their account against, besides just has it gone up or down in the last quarter. But I think when you're thinking about it from a compliance perspective, again, this is one of those areas we can take some of the guidance under the performance advertising rules, or not rules, but just no action letters and clarifications that the SEC has made. And I think the thing to think about is which benchmark or which index are we going to use and why. And a lot of people like to just throw, say, the S&P 500 out there, but not because their strategy is necessarily designed to beat it or even kind of match it, but it's just a good representative, benchmark or index of the market in general. Well, if that's the case, you should say that. So that's where in your disclosures, you should just explain, first of all, what the benchmark is, kind of give the definition of the benchmark, but then talk, is this benchmark, is it just thrown out there just for comparison purposes and that's about it? Or maybe the benchmark is intended to, or maybe the strategies you're using is intended to correlate with that benchmark. And you can certainly use a blended benchmark as well. And again, there, you would just want to define that, explain the benchmark, and then have a disclosure about, the relevance, I guess, of comparing the client's portfolio against that benchmark.
Yeah, and Jared, I just want to piggyback on that, because from a compliance standpoint, what you mentioned is also so important just from a best practices in terms of client communication, what we've seen. You mentioned a lot of people will put an S&P or, the Barclays aggregate bond index or some generic index up there as context, right? A lot of advisors have moved away from benchmarks because they're performance focused and they're trying to beat a benchmark. And they've started embracing benchmarks as, here's an opportunity to give my client context, like you said. And we see that too. It's a good compliance practice, and it's a great practice from a client communication standpoint too, because it's just a really helpful way to illustrate context for your client, rather than looking at a return in isolation that the average client may not have the sophistication or the savvy to understand that. Certainly, if you're trying to beat a benchmark, then if you are a performance manager, that's great. And then obviously getting the benchmarks on the report is really important. And like you said, disclosing that as much as possible and as clearly as possible, a must do from a compliance standpoint. Also very helpful there, just from a communication and client expectation setting standpoint too. And one thing that we've seen on our side with advisors talking to their investors around benchmarks, right, is making sure that even in a bear or in a bull market, the benchmarks that are used there for context are really, the communication is really done in a way that the client understands that, rather than having in their head that they might be trying to beat that. Again, you mentioned the cost of investing and representing that. Super important to remind clients that indexes are pure returns. We've seen a move, and I believe GIPS is starting to recommend actually more and more using investable benchmarks. An investable benchmark, of course, is just very simply using a security to actually benchmark your account against versus a pure index. And then that security will have some sort of representation of the cost of investment baked into that price change over time. So using like an IVV instead of an S&P, again, very important to disclose what you're using and how you're using it, regardless of the decision you might be making there. So I think that to tie it all together, right? We talked about some of these common confused terms: unrealized gain loss versus performance. Why we recommend using the time-weighted returns, and saw some good questions in the Q&A, which we'll get to at the end, around other situations and other return measurements that you might use. And then, of course, the importance of compliance and disclosure and just clear communication. You're really killing two birds with one stone there. You're getting the benefit of a compliant disclosure process, and you're also getting the benefit of a clear communication with your client. So moving to the next piece then, another common question we get, right? What do I need to tell? And this is sort of the underlying thing, Jared, it sounds like for a lot of these is, what do I need to be disclosing to who? Do I need to disclose something different for clients than to examiners? And how do I maintain records and disclosures for that compliance purpose? It sounds like really the centerpiece of a lot of the compliance for reporting is this disclosure and retention.
Yeah, it really is. And I think when I use the word disclosure, a lot of people think, very legalese, small print, just it's got to be in there. I'll get questions from people, send me some disclosures I can use. And I really say your disclosure should be built to be consistent with the report or the document you're giving to the reader, to the client. And so for that reason, the disclosures you might use on one type of report could be different from another report, could be different from what you put out on your website, could be different from, we're talking about performance marketing. So there's not a one size fits all disclosure, and you really want to think about and use the disclosures to help kind of further the discussion of the reports. And when you're thinking about who you're writing these disclosures to, these two bullets, that's really who you are writing, right? To the client, to the examiner, and they go together, right? So the examiner is looking at it to see, did the client, especially, thinking about if a report is overly complicated, overly complex, regulators don't really like that. It's like you're talking over the head of the client. So even starting just with like definitions, we were talking about internal rate of return, some other terms. I like to define those terms out and explain it so there's no doubt. So that's one area you could do that in the disclosures. I was talking earlier about maybe the accounts, whether you manage the account or you're just doing it as a courtesy. You could cover that in the disclosures. But you don't necessarily have to put them in the disclosure, because you could just put that, maybe if you have a cover little letter, or some people will put a newsletter on top of their reports, or just embed some instructions or descriptions kind of, within the presentation, not necessarily just the disclosure. So the key part of the disclosure is just kind of explaining what's going on. And I also like to, when I'm thinking about what are the examiners, I try to go through and say, what questions could an examiner have about this report? And then I'll put the answer to that in the report. And I'm just throwing out some examples, but like we're talking about gross of fee, net of fee. Is it clear that it's net of fee? I bet you the examiner is going to ask. So let's just go ahead and put that a sentence in the disclosure to account for them. And again, we're talking about the benchmark. Guaranteed a regulator is going to ask, why did you pick this benchmark? Well, let's go ahead and put that in the disclosure, so that ideally when the examiner is looking at these reports during an audit, they get all their answers just by reading the disclosure itself. One kind of high level, just because of this next bullet as far as compliance purposes, I would definitely say that before you even start generating the reports, doing some due diligence on these portfolio management tools, doing your due diligence on Bridge's tools and Bridge itself, that's an important thing, when you're looking at any service provider, and not just initially, but annually thereafter, and getting compliance involved, not just the portfolio managers and kind of business development people involved, but getting compliance involved to look at the the tool itself, the reports itself, and that should go through a due diligence compliance review process. And then an ongoing basis, compliance still maybe annually, they're re-looking at the tools and the reports being used, but then also throughout the year, kind of spot checking that stuff as well. So the user, again, there's no rule about it, right? But once you start using it, you want to definitely make sure it's covered in your general policies and procedures. I don't know if you want to go to that next screen. The next screen, we just kind of literally copied and pasted, and I'm not going to read through every bullet, but the key part, the key takeaway is that once you decide to provide performance reports and get those to the clients, that essentially, think of it just as that's just another type of correspondence to the client. You definitely need to keep it. You need to archive it. So you need to archive all reports that are provided to clients. You need to keep that as part of your books and records for a minimum of 5 years, and it's even in bold here, from the end of the fiscal year in which that report was provided. After that 5 years, if you want to get rid of them, you could. Now, during an actual SEC exam, they typically go back about 12 months to 18 months. Just know that during an SEC exam, they could ask for every single report you've given to clients. Chances are they'll probably pull more of a random list of clients and ask for the reports for those particular clients. But that's where it is definitely important to have a good archiving source to have some assurity that they are being saved. You know where to go get them. You can grab them and you can get them and deliver them, to clients, or not clients, but to the SEC or a state regulator when requested.
And the great news around things of that sort, in terms of retention, right, is when you work with a third party, most of them, we're obviously not the only ones that do this, but we certainly have a focus on it in terms of making sure that those reports are retained and that there's a ledger of all those transactions and fees and flows. All this is happening automatically. And, the benefit of cloud-based technology is this can stretch back automatically much longer than 5 years, even in terms of the ledger of transaction and fees and flows. Makes it much easier to go through that examination process. I can imagine, if you can just put in an email or hop on a chat to your portfolio management provider and say, hey, can you give me a trade blotter for everything over the last 24 months? Or just go into the tool yourself and do it. I would imagine, again, really helping streamline and give a third party to be able to lean on a little bit in that examination process.
So here on this slide, I'll be honest, this is just kind of our starting point, disclosure sample template. You'll see right there, it's not customized, but I wanted everybody listening to kind of see this kind of a minimum disclosure that I would recommend in any sort of report. And if you're asking like what absolutely has to be in here, basically what's bolded there. Any firm that has custody of client accounts, and I'll keep in mind, custody also includes the ability to debit fees out of client accounts, right? That doesn't require you to go out and get a surprise audit or surprise exam, but you still have to comply with the custody rule. And under that custody rule, it does say that you need to strongly encourage, your clients to compare any reports that your firm provides against the actual statements from the qualified custodian. So that's literally why I bolded that. You'll see in here, this is just language where you can use those disclosures to remind the client to contact you if there's been some changes in your financial situation. Also, we have a disclosure, or an offer of the ADV Part 2A where they could, read more about your services operations. We've got, just language in here about just the risks of investing. Now, what's not in here, right, would be some of those terms, some of those definitions of benchmarks, other methodologies you're using in your reports. I would put those in the disclosure if it's not already covered. So anyway, it's just kind of a sample, and I know Bridge kind of helps out with that as well. I'll give it back to you, I think, Rashid.
Yeah, and Jared, I really liked too what you were pointing out around, making sure to preempt the examiner's questions, right? And if you're going to use a benchmark, disclose it ahead of time. And I think the thing that's really clear in what you've been explaining is good disclosure is good client communication, right? If you're doing a good job from a compliance standpoint, you can leverage that same disclosure as a communication opportunity with your client and as an engagement opportunity with your client, rather than just ticking the box of putting some boilerplate stuff and calling it a day. Really making sure that the disclosure is reflective of what you're doing, which Bridge can help with, of course, in terms of dropping disclosures in and then helping work with your compliance partner to tailor that. But then using that as a launching point to have a client communication and an engaged client meeting. So I know Margaret has some other parts of the tool that she's going to walk us through. The disclosure piece is just one of those. So I'll turn it back to you, Margaret, to walk us through the tool itself.
Great. Thanks, Rashid. Thanks, Jared. I'm going to go ahead and flip on my screen right now and just show some of the, as you both mentioned, just show some of those steps in action. So as Rashid mentioned, our portfolio management software is designed to help advisors produce reports for clients. And the goal is to provide consistent reports to clients without adding additional work for the advisor. So one of the ways that we do that happens on the back end is we have direct feeds with most major custodians. So TD Ameritrade, Schwab, Fidelity, Pershing, all of those custodians are sending us their data on a nightly basis. We are processing that data and then we are loading it into this system. So that's one less thing for the advisor to have to manage is the data management, adding new accounts to the system, reconciling for corporate actions and stock splits. That is something that our system is doing automatically behind the scenes. So what I'm showing right now is the advisor dashboard. So each of our advisors gets their own white labeled portal where they will log in. The main goal of the system is for us to help with both billing, reporting, and then also providing actionable insights on what's happening within client accounts. And that's really what this first landing page is designed to do. So when our advisors log in, they'll see various data points on their client accounts. So for example, you see this cash monitoring table right here. This is going to alert an advisor to accounts that have a high percentage of cash within that account. We also have down here some firm-wide reporting. So some of the questions that you may get around an audit. We have transactions, all of these different data points in the dropdown you can see here. You can actually just come into the system and run a report, export that directly to Excel. We also have a client success team that works closely with all of our advisors. So if you do have other questions, again, you're getting audited and you need some additional support from our team, there are various ways that you can reach our team. We also have some self-help articles through the Help Center on here as well. The main focus for today's presentation is going to be on the reporting side of things and on the client reporting that we offer. So the system offers two formats of reports. We have both web-based digital reports, which are our on-demand reports, and then we have printable PDF reports. Both of the reporting formats, we've designed different sub-reports, so you can select from the sub-report library. You simply include that report if you want, or check that box if you want to include that report, and then you click generate. You can change around the time period, but it's meant to be a really simple and straightforward to come in and access a report. The system will automatically run consistent reports on a monthly or quarterly basis for all of your accounts and households as well. So we allow our advisors to set up their monthly or quarterly reporting package. And then about 5 business days after the end of the month or quarter, our system is going to automatically run all of those reports, again, for every account and household. Each client will get a white labeled report. So again, keeping with the topic of consistency, the system will remember to run that report for you every month or quarter, and it's going to deliver the same sub-report options that you deliver to your client, or that you deliver to your client the previous month or quarter. So on here, I just have a couple of samples. I'll point out some things. So on this household summary page, you'll see we've added a blended benchmark down here. We do allow our advisors the ability to customize benchmarks within our system. And then from here, you can kind of pick and choose what other reporting options you want to show. So some of our advisors will like to include performance on the individual accounts within the household in addition to the household performance. So again, we offer a lot of different options, and you have the ability to either include or exclude this entire report. Another simple snapshot report that we recently rolled out is just this one-page report that combines some of our most commonly used charts and graphs. Again, you can see the benchmarks down at the bottom, but this is just a way for clients to get a quick view of the performance within their account, change in value, asset allocation, without having to scroll through a few pages. So if this is what, if you're looking for simplicity, this report is designed to give you just that. And then scrolling down, we have super basic disclosures on this demo environment. But again, as Rashid mentioned on that last slide, you do have the ability to customize those disclosures and include some of the topics that Jared had mentioned. So these print automatically on all of the reports that are generated from our system. Going back here to the web-based report, the web-based report has the same sub-report options that we just looked at on the principal PDF side. So the goal of the web-based report would be, instead of logging into your custodian, you would be able to log into our system and see information updated through previous close of business, not only at an account level, but also at a household level, which is different from what some of the custodians can provide. Some of our advisors will use this when a client calls in, or they'll just use this during a client review, pull up this screen, especially as things are transitioning to more of a virtual environment these days. So just scroll through quickly some of the options. Again, it's going to look very similar to what we just saw on the PDF side of things. So if you wanted to do a quick review of this digital format and then generate that to a PDF report for a client, that's a great way to prepare for a client meeting and get a report deliverable for that meeting as well. Just to point out our performance chart on here, as Rashid mentioned, time-weighted performance returns net of fees, and then you can decide what benchmarks are showing on here. Various reports around asset allocation, also target versus actual allocation. If you're wanting to explain to clients why you're making certain trades within accounts, if you're trying to keep within the allocation or the plan that you all have discussed, then this is a great visual to show the variance within the account and the actions that you're taking in order to get that account or household back on track. We have lots of transaction reports. So in addition to the income report and the realized gains and losses report, we also have buys and sells, deposits, withdrawals. So back to what Jared was mentioning about some of the audit retention requirements, you would be able to come in at any household or account level and generate a transaction report, for example, for a particular household on demand within this system. And again, we are also happy to support our clients during an audit, so we can provide some additional information if there are more detailed requests. And then lastly, down here, we have this appraisals or holdings report. So this is going to show you the holdings aggregated at the household level down to the individual lot levels. In here, you can see we are showing unrealized gains and losses for those individual positions, but the account and the household performance that you're seeing in the system, that is time-weighted performance. We do have a management fee report. This will show management fees that were debited from the account. But on the billing side of things, as Rashid mentioned, we produce detailed invoices as well. So we hosted another webinar with RIA compliance consultants where we covered some of the specifics of billing, invoicing. That's, again, a whole nother topic that requires its own webinar. So if you're interested in learning more about that, happy to provide some detail on that, but we're not going to get into that today. Last thing I'll mention about this is each of these white cards is available to be pushed to our client portal. So we do offer a client portal for all of our advisors. You can select, again, from the sub-report library, which of these on-demand reports you want to be pushing into the portal, so the client can log in, see this exact same information that you're looking at here. And then those principal reports that run automatically each month or quarter, those are automatically dropped into the client portal if you set that. So you don't have to go in and set a reminder to drag and drop reports from our portal into the client portal. Again, that happens automatically. So it provides your clients and you with a consistent deliverable each month or quarter. Just going to hop back into the PowerPoint. Rashid, did you have anything else to add there?
No, I think that's a great overview, and I know you've got some more tips here to cover as well.
Yeah, so just to summarize again, the goal of client reporting is that it should be informative for clients, but it should also be something that is easy for you as an advisor to deliver to clients on a consistent basis. So it should be easy for you to run and also easy for the client to understand. So a big focus is always on transparency. The goal of reporting is just to be transparent with clients and maintain that level of trust. So we've designed our system, again, to limit complexity and enhance automation. And so the way that we've designed the reporting environment, again, with those sub-report options to select from, that allows our advisors to avoid information overload, keep their reporting concise, and again, automate the delivery by templatizing that reporting so that it's not adding another item to their plate or their team's plate every month or quarter. So with that, Rashid, I'll turn it over to you just to kind of tie things off, and then we will get to some of the questions we have coming in.
Yep, that's great. Thank you, Margaret. And I want to really emphasize too, in terms of that conciseness, Jared, one of the things you had mentioned before is that many times actually the examiner may look unfavorably or at least with greater skepticism at that information overload. So it's another great example of best practices from a client communication standpoint, very strongly overlapping with best practices from a compliance standpoint in terms of making it easy for your firm to be adherent to compliance and also to instill confidence in the examiner when they come in to look at your reporting practices. Other pieces to emphasize from this, and then just tie off with the Q&A as Margaret mentioned. Right, Jared, another thing that I think you did a great job, and I appreciate you making it clear and easy. I think a lot of times advisors, and for good reason, right, there's a lot of uncertainty around how to do things, and is it going to be complicated? Is it going to be hard or burdensome? And one of the big takeaways from a lot of information you shared today for me is, really with adherence to these key recommendations that you're making, they're very specific, but it's not the most convoluted thing if you really stick to those recommendations that you're putting forth. And if you work with a great compliance partner like RCC, you guys are going to make it even easier for advisors to be adherent, I think, to those best practices.
I totally agree with that. So
cool.
Well said.
It looks like we've got a few questions rolling in. So we've got about 6 minutes left. If you have any questions, feel free to submit them and we will try to get to them. If not today, we can shoot you an email response as well. But the first question that we got is there any scenario where IRR would be preferred?
That's a good question. And again, just to confirm, Jared, from your perspective, from a compliance standpoint, there's no requirement to do one or the other, correct?
Correct.
Right.
Yeah.
So it's really going to come down to the nature of what you're reporting on. So if you look at the GIPS recommendations around when you would use IRR versus when you would use time-weighted returns. It's for an investment advisor, for a financial advisor, it's pretty rare. The most common places that you see IRR preferred is actually from fund managers. So a hedge fund or a VC or a PE fund manager, where the manager themselves may actually control the cash flows. All right. So if you go back to the distinction between IRRs and TWRs, if you are tracking performance with IRR, it will be impacted by cash flows, which is, again, if you are in control of those cash flows, then that may be an instance where you would use that. But given the nature of deposits and withdrawals in a client account, which you may have discretion over, but not complete control over, that's where it's very rare we would see it recommended. It's very rare that we would see this recommended for client accounts.
Another question that we got is around ad hoc reports in the middle of a month that doesn't match the custodian's month end or quarter end statement. Jared, anything around disclosures or things to note on that?
Sure. I mean, I would actually go back, and I like that question to me raises a bunch of questions in terms of like, why don't they match? What was going on? I think the thing to keep in mind, on how serious something might be is it's always facts and circumstances specific. That's why I like to say earlier, regulators get to look at stuff 20/20 hindsight, after the fact. So if you're looking at, like, first of all, any report should have that disclosure, even if it's an ad hoc report, even if it's something you've built internally, right? And that's why I like using a third-party source. I think internally written or internally developed reports are just probably more subject to error, stuff that's more manual. So using automated tools helps alleviate that. Not that you couldn't do something manual or ad hoc or off, again, ad hoc could still be something pulled out of an automated tool. But anyway, point being, I think looking at what was the issue, what was the inaccuracy, and then if you identified it, I think making a correction and sending out a corrected report, even if it's, a few weeks later, action steps like that. Again, the disclosures, if you had a disclosure where you told the client to compare that report against the account statement, and part of that is that the account statement's the overriding record, those things would help limit or minimize kind of that risk of having errors or having, an inaccurate report. So that's, again, where those disclosures can help out, having policies and procedures designed to kind of review and identify if there have been errors and making corrections. And the other thing Rashid was saying there, explanation on that last question. The only thing I'd throw out there again is a lot of times the regulators will just come in and they just want a reason, like a justifiable reason on what you've decided to do. Whatever terminology, whatever methods you're using, whatever benchmark. And I always say, if you've got a good, thought out, reasonable, because policies and procedures, compliance policies and procedures can be reasonably designed, especially when there's not a rule. So if you've thought this stuff out, you've had a reasonably designed policy and procedure, reasonably designed to identify errors, correct those errors when you found them. Stuff like that goes a long way, where during an audit, the SEC kind of looks at it and just moves on to the next thing. If you have a hard time explaining why you're using one over the other, or they're the ones that found a bunch of errors, I mean, they're going to look at that a lot, less favorably than the opposite.
And Jared, another question there, or clarifying thing too, I would ask. So do you think it would be a successful strategy then if an advisor is providing reports sort of intra-quarter, where they would put that preemptively in their disclosure and call that out, hey, if I'm providing a report in the middle of a quarter, note that, this is not necessarily going to match a statement value if those statement values are based off of end of period. Is that something where that could be a successful strategy to preempt that question?
Yeah, and that's a good point. And that's one way to look at that question, is that if that report was sent at the middle of the month, the most important part is that it's consistent and accurate with how that account was at the middle of the month. So that's your biggest underlying issue, is that maybe the download you're getting from the custodian is flawed, or just, that they're not matching up. That would be a much bigger compliance issue than simply, you did a report mid-quarter, mid-period. And so that's not going to match up if they're comparing it against literally the physical, paper month end or quarter end statement. So yeah, disclosure could certainly help explain that and help alleviate that. And I don't even know if that would be a major compliance issue, because of the fact, as long as when it was made mid-quarter or mid-period, that it did match up and was consistent with what the account was at that time. If that makes sense.
Yeah, that's helpful.
I know we're coming up on time here. There are 2 more questions that I wanted to try to get to. One question for Rashid: how long do Bridge reports archive, or how long does Bridge archive reports that have been generated for clients?
Yeah, and that's pretty straightforward because it's indefinite, right? We by default never delete a previous performance report. A lot of clients a lot of advisors that we work with choose to use a separate archiving tool, because that separate archiving tool might also archive email communication and things of that sort. But by default, we archive those on our system indefinitely.
Thanks. And then this is a 2-part question, but just kind of one of the Bridge related questions as part of it. Is there any way to turn off reporting from clients that log into the portal? I can take that one. That you are able to turn off both the web-based reports and or the PDF reports from the client portal. And then within the web-based reports, so those digital on-demand reports that we saw, you have the ability to decide which of those reports are pushing to the client portal. So if you, for example, just wanted to show account balances but not performance, keep that for your PDF reporting on a quarterly basis or however often you do it. That is an option as well. And then the last question is for Jared, it looks like, just as far as an advisor has a client that was brought over from another advisor's previous RIA. So that performance data is not included in their current performance. So is there something that can go into the disclosures to note that?
Yeah, and that's, to me, that's somewhat of a interesting question, or loaded question as well. I could look at either way. Is, one thing to keep in mind is when you're bringing accounts over, and I tell this is not just with reporting purposes, could be client files, everything. Like I talk to people who, they're shutting down one RA firm, or they're leaving an RA firm to set up a new RA firm, right? When they bring their clients over, sometimes people forget that client's now a client of the new RIA firm. And it's the old RIA firm that had all the historical archive. Like the rep there's not a regulatory requirement for the rep to bring that stuff over to the new RIA firm. In fact, unless you get the client's okay, you really aren't supposed to do that. So I would kind of look at this maybe a little bit deeper and think through, okay, what are we reporting on? It says 10 years prior. Are we still reporting on that stuff when that was management and performance attained at a prior firm, not our firm? So definitely having a disclosure around that. And then, so the short answer is yes, definitely using some disclosures or explanations on what you're reporting on, but then also start thinking about, as a firm, not just blindly reporting on an account that's 20 years old because you've got the access to it. You might want to say, okay, well, our firm, we're only going to report once our firm started managing it, because we don't want it to look like, it's similar to what I was talking about earlier, reporting consistently on accounts that you're not actually managing, or you're not actually charging a fee on. You're not charging a fee, you're not getting credit for that, right? Your agreement, you don't have any protection if you don't have agreement on that. You create this kind of precedent, at least in the client's mind, because you've reported on it every quarter that your firm really was responsible for it. And so that kind of opens you up to that risk. So again, disclosures can be used to help try to limit that and explain that and just kind of limit your risk exposure.
Great. Well, I know we are a little over actually on time. So Jared and Rashid, I want to thank you both for your time, your expertise this afternoon. This has been really helpful. To everyone that attended, thanks so much for taking an hour out of your busy weeks to join us. I've gotten a couple of requests for the slide deck, so I'll be circulating that around, as well as a reporting ebook that we have. So expect an email from me following the webinar if there are any questions as well. Rashid and I both have our emails up here, and then this is Jared's phone number. So feel free to reach out to any of us with questions.
Sounds great. Thanks again,
Thanks.
Rashid and Margaret, for having me on this call. I appreciate it.
Yeah, thanks for your expertise today, Jared. It's been fun. Really appreciate it.
All right. Thanks all. Have a great rest of your day.